Hello everyone, it's time for this week's market analysis. On this channel, we break down trading strategies and insights in a way that's easy to understand, all through chart analysis based on Dow theory. If you want to dive deeper into the methods we use, there's a link to an explanatory video in the description. Be sure to check it out. Let's get as good at technical analysis as a raccoon is at using its paws, crafty and quick. If you found this video helpful, please give it a thumbs up and subscribe to the channel. Now let's jump into this week's market. Let's take a look at the USDJPY chart, starting with this week's price action. On the weekly chart, the market formed a bullish candle with an upper wick. Last week, we saw a relatively large bearish candle, which was triggered by the previous week's upper wick, suggesting increasing bearish pressure. However, this week's bullish candle pushed against that downward move, indicating some buying strength. That said, the long upper wick also shows that selling pressure is still present. Next week, we'll be watching closely to see whether the market continues to aim for the weekly resistance line. Now let's move on to the 1-hour chart. The yellow vertical line marks the beginning of this week's trading on Monday. As of last weekend, the 4-hour trend had turned downward, so both the daily and 4-hour charts were in downtrends. In last week's video, we mentioned that unless the 1-hour chart reversed to the upside, sellers would likely hold their positions toward the weekly resistance line. However, the 1-hour chart did flip to an uptrend at this point, which triggered a take-profit scenario. At the same time, price also broke above the descending trend line. Following that, we were watching for new short entries near the 4-hour swing high or previous swing low levels. But price broke above all of those levels, confirming an uptrend on the 4-hour chart. However, the daily chart is still in a downtrend, and the 1-hour chart has since turned bearish again, so a renewed decline toward the weekly resistance line remains a valid scenario. Let's now analyze the current market conditions, starting again from the weekly chart. On the weekly chart, this purple line marks the swing low, and price has bounced without breaking below it. Since the candle bodies haven't closed below that level, the weekly uptrend remains intact under Dow theory. However, the correction was deep, and price failed to break the recent high, both signs of growing bearish pressure. Overall, it's a market with unclear direction. Most recently, the price bounced upward from the weekly resistance line, but that move was followed by a drop from last week's upper wick, showing that sellers are still active. Although this week formed a bullish candle and price didn't immediately fall, unless that upper wick is invalidated by a stronger move up, we should continue to expect the market to aim for the weekly resistance line. If the market continues to drop from here, it would be the 4th touch of the weekly resistance line, so we need to be cautious about a potential breakout. Looking ahead on the weekly chart, we could either see a 3-leg downward move or a bounce from the weekly resistance line. If the market confirms a 3-leg down pattern, the next key level would be here. This line represents the projected target of an N-wave pattern and has also served as a support level in the past. Let's move on to the daily chart. Currently, the daily trend remains bearish. This line marks the most recent swing high. Even after the recent upward move, price failed to break above that swing high and then resumed its decline, so the downtrend is still valid. Last week's temporary rally ended with a large bearish candle and a long upper wick, once again indicating strong selling pressure. On the daily chart, we'll be watching to see whether price forms a lower high and lower low structure without invalidating that upper wick. Our outlook remains bearish for now. Next is the 4-hour chart. We're currently observing this wave structure. This week's rally broke above the previous swing high, confirming an uptrend on the 4-hour chart. The current swing low is located here. However, the market has started to decline again, and this movement corresponds to the upper wick seen on the weekly chart. Given the size of this drop, if we begin to see lower highs and lower lows forming, even without breaking the current swing low, many traders may interpret it as a trend reversal to the downside. Additionally, we can assume the market may be forming a head and shoulders pattern. If that pattern is invalidated, it would be a strong sign of bullish strength and increase the likelihood of further upside. Now let's take a look at the 1-hour chart. At the moment, the 1-hour chart is showing a bearish trend. The most recent swing high is here. If price breaks above this level, it would be wise to hold off on new short entries for now. However, since the daily chart is still in a downtrend, if this level fails to turn into support, we should anticipate another bearish reversal. The best approach would be to wait for a confirmed bearish reversal on the lower time frames before considering new entries. To summarize the trend across each time frame, the weekly chart lacks clear direction, the daily chart is in a downtrend, the 4-hour chart is currently in an uptrend, and the 1-hour chart is in a downtrend. Until the 4-hour chart confirms a reversal back to a downtrend, it's best to keep both bullish and bearish scenarios in mind. Now let's talk about the scenarios going forward. Starting with the bearish scenario, on the daily chart, upper wicks on the candles indicate selling pressure. This is a market where we want to look for selling opportunities on pullbacks. The key point to watch is whether price forms a structure like this and breaks below both the neckline of the potential 4-hour head and shoulders and the 4-hour swing low. Entering on such a pullback and placing a stop just above this level can offer a good risk-to-reward setup. However, if price invalidates this right shoulder and forms a higher low, we need to drop the bearish bias and reassess the situation with a neutral stance. If the 4-hour swing low is broken again, both the daily and 4-hour charts would be in downtrends, making it a much more favorable environment for selling. In that case, we'd actively look for new short entries on any pullbacks. Now for the bullish scenario, the market has bounced from this support level, which is also the swing low that formed the current 4-hour uptrend. As long as price doesn't break below this level and instead continues to build higher highs and higher lows, we can consider buying opportunities. If entering a long position, we'd want to place stops below this 4-hour swing low. However, given how deep the recent pullbacks have been, we still sense significant selling pressure in the market, so any long entries should be approached with caution. In general, it would be safer to hold off on long entries until the price reaches the weekly resistance area. Once there, we can watch the lower time frames for bullish price action before considering any long setups. Next week, we'll be focusing on whether price can break above the recent high and continue forming an upward wave, or whether it starts forming a series of lower highs and lower lows. Did you find that helpful? If you did, please give this video a thumbs up and subscribe to the channel. Next week, let's be as skillful with technical analysis as a raccoon is with its paws, and trade with the same caution a raccoon shows in the wild. I wish you all successful trades. Best of luck.